Hello there, welcome to The Open. Happy Friday. Let's get to the big stories we're bringing you from our newsroom. Canada's economy shrank at the end of last year. Data from StatsCan indicates that gross domestic product, fell 0.6% in the fourth quarter, driven by a sharp decline in business inventories. The decline was partially offset by increased household spending, exports, and government spending. Overall, GDP increased just 1.7% last year, the slowest pace of annual growth since 2020. In a preliminary estimate, the agency suggests real GDP remained unchanged in January. Canada will begin halting tariffs, China will begin halting tariffs on Canadian canola starting next week. The move comes after Prime Minister Mark Carney's visit to China in January, where a deal was discussed to drop tariffs on canola, peas, lobster, and crab in exchange for Canada cutting levies on Chinese electric vehicles. Endeavour Silver posted a fourth quarter loss of more than $23 million, even as the Vancouver-based miner reported record revenue for 2025 of more than $465 million. Endeavour says 2025 was a transformative period, with the CEO pointing to the commissioning of the Terronera and the acquisition of Culpa mines as key milestones. U.S. futures down. A read on producer price inflation came in higher than investors wanted to see. Let's have a look at the TSX, which ended at a record high yesterday once again. And let's check in on oil. Oil actually weakened in afternoon trading yesterday amid fears still that the U.S. is poised for an attack on Iran. And you can see oil now up, not far short of $68, the North American benchmark, hitting a multi-month high. And let's have a look at gold to see if it's getting any kind of flight to safety. Sure enough, geopolitical uncertainty, and the latest, of course, being the risk of a U.S. attack on Iran, helping to push investors into bullion. And let's have a look at the Canadian dollar. And it is holding its own today, pretty comfortably above 73 cents US. And finally, Bitcoin. Bitcoin, the biggest crypto, still red on the screen, barely above $66,000 US. So we got a shrinking in the economy in the final quarter of 2025. And for the year as a whole, growth was the slowest since 2020, since the pandemic, at 1.7%. We're joined by Carl Shimada, Chief Market Strategist at Corpay. Carl, great to see you. I suppose in a way,
well.
It could be worse. I mean, given that our biggest trading partner is spurning us in many ways.
That's right. It could have been much, much worse, right? Clearly, last year when the tariffs were initially announced, there was a lot of panic. There was a lot of concern that the Canadian economy was headed into sort of an imminent recession. When we really looked back at the record, the Canadian economy has proven far more resilient than I think many expected. One thing to kind of highlight is that if we look at growth on an overall aggregate basis, we've outperformed everybody in the G7 other than the U.S. Since the beginning of the pandemic. So real gross domestic product is up around 10.9% relative to where it was in the fourth quarter of 2019. The U.S., of course, is 14.9%, but we're well ahead of everyone else in the advanced economy club, right? And so this does point to a degree of resilience among Canadian households, businesses, and the government itself.
That's interesting. I mean, we've heard such a chorus of gloom, haven't we? That, declining productivity per head. And I know that's a different beast in a way. That was partly the surge in immigration. But so we have, relatively speaking, our economy hasn't done that badly.
That's right. Now, you're right. The big key thing here is that we did see that immigration boom. So, on a per capita basis, we look much less impressive. Productivity looks much less impressive. But, the fact that we also had commodity exports holding up very well after the Ukraine invasion, and the housing boom sort of going on for a couple of years there, that has all, underpinned that stronger performance. And so, it is a mixed picture. There's no, kumbaya moment here for Canadian policymakers. But the reality is that on the metrics that, currency traders look at, that global investors look at, the Canadian economy is holding up pretty well. And I would also say, although we've seen a negative, reaction to that headline number this morning, if we look under the hood, the underlying fundamentals are fairly positive. I mean, if you look at, household consumption, household spending, business investment, and government spending, and you strip out the inventory and trade effects, which we know are being distorted by sort of bullwhip effects in global trade. If we look at those fundamentals, they're actually relatively positive. They are pointing to some resilience there, and in fact, I would even say that the drop in inventories is a positive harbinger of what we might see in early 2026. So, definitely, I would strongly encourage investors to look through that headline number.
The excuse me. The U.S. stock market, though, even though it's surged, obviously not far off record highs, even though shares have been a bit sloppy this month, but it's not far off record highs. Have other markets or equity markets around the world been outperforming us? Can you remind us, Carl?
Yes, massively. So, if we look at just the last year, global markets are up roughly 44%, while the U.S. is up 18%.
Wow.
If we look back even prior to that, on sort of like if we want to remove the Trump bump, as it was called, in late 2024, the U.S. is still at the bottom of the pack. So, I wouldn't necessarily say that this is a reflection of, a terrible outlook on U.S. growth or anything like that. We know that the tech sector had gotten, sort of overvalued at some point. We know that some of that needed to be rotated away. But it is very clear that that other global markets are participating here, that investors are reallocating money outside of the U.S., and that it arguably puts the entire global economy on a more sustainable footing, because we're putting more money to work in domestic economies outside the U.S. as opposed to sending it all to the U.S. to reinvest.
It's odd, isn't it, though? Those economies have lagged the U.S., but their stock markets have done better.
Yes, partly because of lower valuations, right? There's been a discount applied to global stock markets relative to the U.S. for much of the last couple of decades. Global investors have been underinvested at home in many, many ways, especially in Canada. For many, many years, we were like living up to our stereotypical role in the world. We're very, very polite, taking our money and sending it to the U.S. For reinvestment, as opposed to deploying it at home. And some of that's beginning to reverse, right? People are picking up bargains in those markets outside the U.S. And sort of, I guess, downgrading exposure to the U.S. given the level of instability and unpredictability that is in play down there.
What about our dollar, Carl? What's your call? Are we going to stay above 73 cents U.S. for the foreseeable?
I do think we're pretty range bound here, right? The reality here is that there isn't a lot of reason to buy the Canadian dollar and drive it dramatically higher. But at the same time, we're moving in lockstep with the U.S. And so there's not a lot of good motivation to short the currency that dramatically. So it's unfortunate right now, because I really don't have a strong conviction view on the Canadian dollar in either direction. I can't really see what the catalyst is going to be. And so, the only thing that I can take out of that is that I'm probably being complacent. Markets are probably being complacent. There's some risk out there that we don't know about yet, and we're probably underpricing the likelihood of a move.
Carl, thank you very much indeed.
Thank you.
Carl Shamada, Chief Market Strategist at Corpay. Coming up, tension is rising in the Frank Stronach trial, with the judge halting cross-examination amid emotional, often chaotic testimony from the sixth complainant against the auto parts magnate. Stronach is sticking with his non-guilty plea to charges dating back decades. More after the break. The judge proceeding over the Frank Stronach trial on charges including sexual assault says she is concerned about cross-examination of the latest complainant. It turned into a shouting match. For more, we're joined by CTV's Scott Hurst. Scott, court was called off abruptly with the sixth of seventh complainants on the stand. What more can you tell us here?
Good morning, Andrew. This is a high-profile case because, of course, billionaire businessman Frank Stronach has been such a mainstay in Canadian business for many decades now. But we did see a tense cross-examination playing out in a Toronto courtroom on Thursday in Frank Stronach's sexual assault trial. The businessman had pleaded not guilty to 12 charges stemming from alleged incidents dating as far back as the 1970s, but prosecutors have since withdrawn one count of forcible confinement related to this particular complainant. She is the sixth of seven accusers. She cannot be identified, but alleged she was sexually assaulted by Stronach in 1986. Now, getting back to what happened yesterday in court, the trial was abruptly adjourned on Thursday as the judge expressed concerns over the well-being of the complainant and the possibility the woman's behavior on the stand could impact the fairness of the trial. The Ontario Superior Court Justice Anne Malloy recessed court more than an hour early, saying she couldn't put the complainant through anymore, but stressed the defense lawyer had done nothing wrong. Several times the woman and defense were talking over each other during the cross-examination. The proceedings at times, according to Justice Malloy, Andrew, became more of a shouting match.
What are the next steps so far as we know?
Yeah, so with the court proceedings ending abruptly yesterday, the distressed complainant was being taken for medical care. Now, the court is not meeting today. They are not sitting today, but they're expected to resume on Monday. So we'll have to wait and see at that point how quickly things progress. But as we mentioned, this is still only the sixth out of seven complainants, so there are more proceedings ahead after that.
Thanks very much, Scott.
Thanks, Andrew.
Scott Hurst of CTV News. Coming up, we are going to hear from National Bank's Chief Rates and Public Sector Strategist, Warren Lovely, on that weakness in the economy at the end of last year. We'll be right back. Alberta tabled a budget projecting a multi-billion-dollar deficit, with the Premier blaming federal policies and oil price volatility. This comes as a recent poll shows about 30% of Albertans support separation. But as CTV's Kathy Lee reports, supporters say the numbers don't tell the full story.
In a Fort Macleod diner, the mood shifts when separation comes up, and there's no agreement.
I believe that Canada should be all together.
I'm for it separating.
We'd be stronger if we didn't have to send all of our hardworking money and taxes to bail out other areas of the country.
Alberta independence sparking tension in this small town. Some are eager to talk, others aren't.
And just a couple blocks down from the diner is this place, the Holy Cross Parish Hall, where there was a signing event for people who support Alberta separation.
Including Richard and Ken Orridge, who put their names on the petition.
I'm not doing this for me. I'm doing it for my grandkids and my great-grandkids. I don't have a lot of faith in Central Canada, in our political elite.
Alberta tabled a $9.4 billion deficit in Thursday's budget, with the Premier blaming federal immigration policies and oil price swings. Mitch Sylvester, who is leading the petition drive, says independence would strengthen the province financially.
We send minimum $27 billion one way. So would we be better off? Absolutely.
Recent polling by Main Street Research shows just under a third of Albertans support separation, consistent with other surveys. Those on the ground believe the momentum is stronger.
Yeah, the polls, well, I don't trust them.
And say if the petition goes to a referendum, support will be higher. Kathy Lee, CTV News, Fort Macleod, Alberta.
So the economy shrank in the fourth quarter. Part of that, a big part of that, was a big drop in business inventories following inventory accumulation in the previous 3 months. And some of the drop in economic output was offset by higher exports and spending by households and governments. Let's get more from Warren Lovely, Managing Director, Chief Rates and Public Sector Strategist at National Bank Financial. Warren, great to see you. So this big drop in business inventories, a kind of seesaw thing after a build the previous quarter, that's distorting the number to some extent?
Yeah, I think, Andrew, this is why economics is the dismal science. There's a little bit on the one hand, on the other hand going on here in this GDP report. The headline GDP number, as you mentioned, contracted in the fourth quarter, so that's not great. But there does appear to be some special factors at play. Specifically, this inventory drawdown that you mentioned, and those, wanting to put a more positive spin on this would point to, well, excluding the inventory impact, you can see growth in other sectors of the Canadian economy, in consumption, in government spending, not surprisingly. So there are some pluses, certainly a few more negatives, and as a result, a contraction for the quarter as a whole.
An incredible surge in defense spending or weapons spending. Apparently that was up something like 9-fold, but I guess that's a lumpy item.
Yeah, it's a small item, but I think what you can see and what we are starting to see in the hard data is evidence that the federal government's push to make Canada strong and to build out our military-industrial complex, for lack of a better word, is starting to show up in these data. We know that governments have committed a lot of money to capital spending. Some of it defense, some of it sort of more traditional non-military capital spending. And to be frank, Andrew, I think the economy really needs some of this government support because there are other areas of the economy where we still obviously look quite vulnerable. I'm thinking obviously about manufacturing and trade-sensitive sectors.
And there's another statistical quirk. I know we can't get right into it, but apparently the contraction in Q2 was revised higher, and that distorted the Q4 number.
Yeah, so this is the other thing we continue to deal with, Andrew, is you think you know where an economic reality is, and then a statistical agency can revise the ground and move the ground under your feet. So to some extent, we're kind of constantly trying to figure out where we really are on GDP growth. The same thing holds in the labor market, which is probably, I don't want to minimize GDP, but we got to be watching what's going on in the jobs market as well. We get, on the one hand, indicators that show good hiring, healthy labor market conditions. Just yesterday, we had a very sobering take on payroll employment in Canada. So again, that dismal science comment, we've got, some indicators that point to resiliency, some that are flagging concern. And just on this resiliency point, I think it is worth mentioning that even though the economy contracted in the fourth quarter, we had 1.7% real GDP growth in 2025 as a whole, which I think, to be fair, is probably better than most would have expected given the trade war that we are in.
Bottom line is, has our economy been, I know it's hard to be categorical, but has our economy been hurt by Trump's tariff war and Trump's trade threats, let's call it?
Yeah, I think there's no question about that. I mean, all you have to do is look at the GDP by industry data that came out alongside this report today, and you'll see manufacturing sector, that really critical cyclical factory sector, had a terrible 2025. Exports as well, contracting for the year. So you can see on the front lines of this trade war casualties in the Canadian economy. Thankfully, we do have some evidence of resiliency. And as a result, we did manage to grow the economy despite those trade-related headwinds. But I think, again, Canadians need to understand that increasingly this is an economy that's reliant on the government sector to hold things together, whether that's weapons systems expenditure or just more general fiscal stimulus, because the private side of the economy, business investment and consumers, look anxious, I think, for very good reasons, understandably.
So there was something of a blip upward in business investment, I believe, but that was after 3 negative quarters.
Yeah, as I say, you can kind of, there's a little something in here for everyone. You can find on a quarter-over-quarter basis signs of improvement. Look to the trend.
Yes.
And what the trend tells you is that business investment in this country is largely stagnant. And I think, again, we can understand why. Businesses don't have a lot of confidence. They don't have confidence that we're going to have a really viable trade agreement with our biggest trading partner. That's a no small consideration. And as a result, they've been holding back. And consumers are still spending increasingly on things like rent and services, but consumers are anxious also. And this is where the labor market health becomes really important, because if the labor market is weakening, and there is signs that that is happening, then consumers could stay a little bit held back in terms of their own enthusiasm. So business investment, consumption, these are the real key building blocks of an economy. They both look a little bit in jeopardy here. And as a result, you've got government stepping into the breach. Make Canada strong, protect, secure. These are the catchwords of 2026, and they speak to a very vulnerable economic situation that we're in.
What about the Bank of Canada? They've essentially said we're not doing anything for now in terms of interest rates.
Yeah, I think the Bank of Canada, I'm going to be a bit flippant here. What they've said is we've done enough, or we think we've done enough.
Right.
Which is to say, they have lowered interest rates pretty significantly, as most Canadians know, and that has helped. Think where we would be if we still had the Bank of Canada policy rate setting at 5%. Okay, we wouldn't be growing. So thankfully, some of the resilience that we have in the Canadian economy that we see in these GDP data, I think reflects the fact that interest rates have come down. That's helpful. The bank is telling us, the Bank of Canada, is that, look, they're not really well positioned to fight a trade war, and it should be for governments to be supporting the economy here. And governments haven't needed a whole lot of encouragement, let's be clear. They've come rushing in with a lot of new initiatives, measures, and so on and so forth. So the bank would prefer to stay where they are. Let's see if they have, if they have an ability to remain patient.
Thanks, Warren. Thank you very much indeed. Warren Lovely of National Bank Financial. Those opening bells are next. Okay, it's Friday. Happy Friday, one and all. And here's the opening bell action on Bay Street and Wall Street. At the NASDAQ, Generate Biomedicines is doing the honors. At the NYSE, it's the 13th annual Connor Group IPO Summit, and they're ringing the opening bell. At the TSX, it's Southern Cross Gold Consolidated, celebrating that company's graduation to the Toronto Stock Exchange. Big board. It's time for the first 15. And let's have a look at the North American bourses, the benchmarks, as we get going on this final trading day of the week. And you can see stocks are down in early trading. Toronto dropping from the record high it closed at yesterday. And American stocks are under pressure as well. There's disappointment over producer price inflation coming in slightly higher than expected. But of course, you could say the big driver of the U.S. market right now is speculation as to whether the AI spending blowout has just gone too far, and we're headed for a crash with companies that have taken on too much debt, for example, getting into rough waters. Let's have a look at Endeavour Silver here. Now, that company posting a loss and the stock down a bit. However, a lot of that is to do with the timing of gold hedge settlements. National Bank has a buy on the shares with a price target of $19. Price target of $29. It says that, in fact, production and metal sales volume were pre-released. And sure, there was a miss on the financial results. We think that this is a buying opportunity, and with a whole bunch of gold hedges settled in Q4, fewer hedges remain outstanding, which should positively benefit future cash flows. So it looks like the loss there wasn't related to operations. And the stock down a little bit, but it's what's been the run. It's up threefold in the past year. Let's have a quick look now at Dell, because those shares surging. Look at that, up 17%. Now, this company is a big provider of AI servers, and it forecasts that its business from that category will double in fiscal 2027. They also plan a 20% hike in the cash dividend, and they plan to buy back an additional potentially $10 billion US in shares. And so you can see Dell is off its highs like so many of these AI enablers, but investors like the look of the latest forecast. We've got another AI infrastructure stock here, and it is under pressure. This is CoreWeave, the AI infrastructure provider, posting a bigger than expected loss and also boosting its capital expenditures. And that's a bit of a sore point with investors. There are concerns about the company overspending. And then finally, Block is the financial tech and payment company, says it's slashing jobs, tens of thousands of jobs, cutting them by nearly half. And right now, investors are welcoming that news. Coming up, how to position your portfolio in a broadening market. That's ahead. For investors looking to broaden their stock portfolios, our guest says there are opportunities in value, dividend payers, and small caps, and a lot of them still trading at lower valuations compared with the mega cap techs. Let's get more from Whitney Stewart, Executive Director and Client Portfolio Manager at Sterling Capital. Great to see you, and thanks very much for joining us.
Good morning. And yes, we believe that this halo trade, heavy asset, low obsolescence, is pretty interesting, and you're seeing large cap value, dividend stocks, small cap stocks in the U.S. Up anywhere 5 to 9%, and the reversal of the winners of the last couple of years, Mag 7 technology trade. So we're seeing that as an attractive area on a go-forward basis.
Remind us, what are these halo stocks again?
Yeah, so heavy asset, low obsolescence. So some of those sectors are industrials, energy, utilities. In the AI space, one of the ways you can play it is the electric grid infrastructure. Yeah. So we like Southern, we like Eaton over long-term fundamental. Their backlog is very attractive, consistent cash flows, and they're not as expensive as some of the tech winners in the AI trade.
So Southern, the symbol SO on the NYSE. So it sells electricity? Is that its basic?
Yeah, it is. Yeah, exactly. It's a regulated utility.
Yeah.
So one way to think about it is a conservative way to play the demand for AI is going to drive a lot of electricity demand. It's based in the Southeast, so has very favorable demographics, population growth there. And then Eaton supplies transformers, circuit breakers to the electric grid, which needs to get upgraded anyway. And now you've got really attractive, strong demand from all these data centers being built. They're going to need a lot of power.
Yeah. It's interesting with the tension, it seems, south of the border, though, over electricity prices that people feel are being pushed up by the data centers. But I guess that doesn't hurt the electricity utilities.
Yeah, so there's conversations about regulation. So that's another aspect of evaluating some of these companies. You want to identify the companies that have favorable potential regulation opportunities, because some of the local regulators and potentially national are concerned. about how their prices for consumers may go up. So you do have to do the homework on that.
And then Eaton, I'm not sure if we looked at a stock chart, ETN. I mean, their order book must be just full to bursting right now.
It is very strong and accelerating. And so, typically stocks react really well to an acceleration. And their customers, have potentially hundreds of billions of dollars to spend on CapEx, all the big hyperscalers, Amazon, Microsoft, Google, Oracle. They have a lot of cash flow to build out the AI infrastructure. And ultimately, that leads to Eaton's backlog.
It is interesting, though. I know this is not a new theme, but companies like Meta and Alphabet, for years, people loved them because they didn't have to build factories and plants, but that's changed radically. They're having to build hard stuff on the ground.
Correct, yeah. And the stocks really worked for the last 2 or 3 years, even though they were spending more and more of their cash flow. The market seems to be, again, sort of taking a breather on the Mag 7/AI trade and broadening out. Again, U.S. value dividend stocks, also small caps, are up, 8, 9, 10%, depending on the index you're looking at. And they just have less tech. There's less risk. And then you're also seeing sort of the opposite of the software trade, which is sort of the disaster. And so small caps have less than 3% software.
That's interesting. Do you think, I know this is a bit off topic, but are people being too hard on these traditional software stocks?
I think it's going to be a stock picker's market. So that if you think about software, historically trades at a really high multiple. Let's just say ballpark 25 times earnings.
Because it's asset light.
Asset light. It's highly reoccurring, super high margin business, great business. If all of a sudden the cost of software to develop it is extremely low and potentially disruptible, and these moats go away, then the multiple of these stocks probably should come down.
Yeah.
Now, some of them do have real moats. Some of them, those moats are getting eroded. And the two big competitors coming from the private world are Anthropic and OpenAI, and they have really high revenue targets. Anthropic is looking at close to 100 billion of revenue by 2029, and OpenAI just upped it from 100 billion to 280 billion. We'll see if they get there.
Yeah.
But if they get anywhere close to that, that revenue's got to come from somewhere. And so software profit pool is AI is really good at coding. So we'll see. They are growing fast. OpenAI just did 20 billion annualized revenue at the end of 2025.
Sorry.
OpenAI.
Oh, yeah.
Which is ChatGPT.
Yeah.
And they 2-3 years ago they had almost no revenue.
Yeah. So it is picking up. You have a couple of retail ideas. BJ's Wholesale Club.
Yeah.
Just put them in perspective. Are they like a mini Costco?
Yeah, great question. So a great way to think about large cap and small cap. Where's the value? Everybody loves Costco. Phenomenal store. It's been a great stock. The one issue is trading at 55 times earnings. So BJ's is trading at 20 times earnings, and it has the same membership model, 90% reoccurring membership fees, which makes it real consistent. It's got the cheap gas, and yes, it does have the hot dog and a Pepsi for $1.50. Keeps you coming back, but you're only paying 20 times earnings, and the company's just a lot smaller. Very similar business model with, we think, actually a little bit more growth in the U.S. because there's less existing store base. Most of the stores in the Northeast, they're expanding Southeast, Florida, Texas, where there's more population growth anyway.
That's interesting. It's a mini Costco, arguably cheaper.
Correct. Yeah. In our view, yeah.
Thank you very much, Whitney.
Of course.
Whitney Stewart has been our guest. Whitney is Executive Director and Client Portfolio Manager at Sterling Capital. Yesterday on Market Call, we were joined by Mike Philbrick. He is CEO of Resolve Asset Management. He covered ETFs. His top picks were iShares, S&P TSX Global Base Metals, XBM, iShares MSCI Brazil, EWZ, and iShares Ethereum Trust, ETHA, in New York. Today on the show, Brian Madden, Chief Investment Officer at First Avenue Investment Council. The topic, North American equities. Up next, we have seen a jump in oil prices today amid speculation that the U.S. military is preparing a strike on Iran. We'll have that after the break. So Iran and the United States still talking, trying to get a diplomatic solution on Iran's nuclear program. Meanwhile, oil prices are higher today. There still is the chance of U.S. military attacks on Iran. We're joined by Halima Croft, Head of Global Commodity Strategy at RBC Capital Markets. Halima, thank you very much indeed for joining us. Give us the latest. I mean, what is your base case? Is there likely to be a strike on Iran?
Launch sequence for another U.S. military strike on Iran. Yes, there were negotiations yesterday. There were some positive sound bites about meeting again next week, but the basic divide over whether Iran can enrich uranium domestically or not has not been resolved. And just this morning, we've had reports that the U.S. Embassy in Israel is moving to an evacuation of non-emergency staff. We have similar reports that there is a U.S. Embassy drawdown in Baghdad. They did similar things in the run-up to the U.S.-Israeli airstrikes on Iran in June. So all signs at this moment point to another military confrontation.
The past attacks have not disrupted oil flows out of Iran, broadly speaking.
That is potentially why the White House is confident that they can contain the fallout from another military engagement. What I will say is I returned from a trip to the Middle East earlier this month, and there is broad concern amongst our key Gulf allies that a second military confrontation will not look like the first, and that Iran is more incentivized presently to attack regional energy facilities, attack tankers in the Straits of Hormuz, to essentially impose cost on Washington for engaging in such action. And I would say the fact that the United States overthrew the leader of Venezuela, Nicolas Maduro, also sparks fears amongst the Iranian leadership that anything we do will be ultimately a regime change exercise. And the Iranian leadership, I think, is trying very much to stay in power. And so they will push back hard against what they see as a second U.S. regime change exercise this year.
Would they potentially attack Saudi facilities, or whose oil industry would they launch missiles against?
Concerned about the Strait of Hormuz. They've already done military exercises in the Straits. We have seen in 2019 that one of the first things they did after the U.S. reimposed sanctions on Iran was to attack tankers off the coast of Fujairah, the UAE. And so I do think, even though they probably cannot close the Straits of Hormuz, that all-important critical waterway for the transport of oil and products, that they could absolutely mine the Straits. They could attack individual tankers. So I would look to the Straits. And then again, I think we should be thinking about, UAE's oil infrastructure, Iraqi oil infrastructure. Again, I think that they have the ability, because of their missile capabilities, their short-range missile stockpiles are largely intact. And so those could be deployed against energy assets across the region.
You've been tracking the big OPEC plus producers who have implemented voluntary cuts, and comparing how much oil they're supplying to the market now or recently versus pre-COVID or April 2020. So, for example, Russia is still supplying quite a bit less, or did in January, than it did back then, and the same with the Saudis. So they could, if they wanted, put more oil on the market.
We look at the April 20 production levels as essentially almost potentially near-term peak levels, because April 2020 is when you had a very fierce price war between OPEC and Russia. And so we don't think those producers held a lot back. And some countries have made some capacity expansion since April 2020, like UAE. But we think basically, except for Saudi, every producer is in the market right now. Russia has been suffering significant infrastructure attacks, lack of investment. We do not think Russia has the ability to surge. We think the only country that has the ability to surge is Saudi Arabia. And the amount of production they could bring on would not be sufficient to offset a major attack on an energy facility or a major disruption of transport through the Strait of Hormuz. So one of the challenges for the Trump administration is they were very focused on getting more OPEC barrels on the market the first year in office. But the problem is, if you bring forward that production, you don't have that much left in reserve in the event of a supply disruption. And also think back to the Russian invasion of Ukraine. Part of the reason why we didn't have a massive supply disruption or run up in prices was the fact that the United States decided to release 1 million barrels a day for an extended period from the Strategic Petroleum Reserve. We have not rebuilt our SPR. So again, the shock absorbers in terms of spare barrels, everyone's been focused on a well-supplied oil market, but if you have a physical supply disruption, then you focus on what barrels can you bring on very, very quickly to fill the gap. And that's where we have a shortage if we do indeed go to another round of military engagement and it is more disruptive when it comes to regional oil supplies.
Oh, that's interesting. So the valve can't be turned up that much in the short term. That's very interesting.
Right. U.S. production is not a light switch. Whenever you have a supply disruption, that's the phone call is made from Washington to Riyadh. And again, they've already brought forward barrels. There just isn't a massive shock absorber if we were to get to a serious military conflict in the Middle East.
Halima, thank you very much indeed. Halima Croft is head of global commodity strategy at RBC Capital Markets. Really appreciate it. Up next, the Prime Minister lands in India to kick off his latest overseas trade trip. Prime Minister Mark Carney landing in Mumbai, India this morning. Let's find out what's on the agenda. We're joined by CTV's Jeremy Sharon. Hi, Jeremy. Can you remind us what's on the itinerary and what has the Prime Minister and the government said about this trip?
Yeah, Andy, look, lots going on. This first stop is in India. Then the Prime Minister will travel to Australia and Japan. But there's much focus about the India portion of this trip. It is the lengthier portion of it. And what we know is that Canada and India have agreed to work towards an eventual broad-ranging trade agreement. It's not expected that will be finalized during this trip. But we do know that a lot of work will happen to kind of get the ball rolling, if you will, on making progress toward that eventual trade agreement that the two sides are looking to work towards. We're talking about two nations in Canada and India that are looking to diversify, especially in the face of changing relationships with the United States. We know that themes of interest between the two will be energy, education, tech, crime, and immigration. We know the Prime Minister will meet with Narendra Modi, the Prime Minister of India, on March 2nd. And we know that specifically when it comes to energy, there is a great interest there from the Indian government to look and try and find a new energy market to import from. When we look at where India is getting its energy from, most of its energy, its oil, where it's importing oil, especially from, it is getting most of its oil from Russia. And India is under immense pressure, especially from the U.S. administration, to stop getting its oil from Russia. And of course, Canada is looking for new export markets for some of its energy products. So there is a natural, connection there, if you will. And I think we can look for multiple memorandums of understanding to be signed during this trip. But both sides are certainly looking to bolster the trade relationship and looking at avenues in which they believe there is room for cooperation and collaboration down the road.
So the government says India has dropped its policy of murders in Canada. Well, I'm being a bit facetious, but one killing, of course, they were linked to. In Canada, the Sikh community has spoken out here. Wants the government, it says, to take a firmer stand on India. Can you give us a bit of context there?
Yeah, look, Andy, despite everything we just talked about, there are significant challenges, of course, and serious challenges in, reigniting diplomatic relations with India. The first being what you just referenced, which is the killing in 2023 of a Sikh activist, Hardeep Singh Nijjar in BC, which the RCMP and former Prime Minister Justin Trudeau have linked to the Indian government. Beyond that, the RCMP has identified as recently as just last year, that India is one of the main perpetrators of foreign interference and espionage. Despite all of that, what we heard in the lead up to this trip was a senior government official in a briefing with reporters say that, in fact, Canada believes that India is no longer actively taking part in those kinds of activities, and that if that were the case, that the Prime Minister probably wouldn't be going on the trip. Yeah. That has sparked pushback. The Sikh community in Canada is pushing back and asking the federal government to clarify its stance on whether or not they believe and continue to believe that there is a level of threat from the Indian government when it comes to some of those things, transnational oppression, certain crimes that they've been alleged of. What we have not seen yet, Andy, is an official response from the federal government, from officials, and I mean elected officials, the Prime Minister or ministers, because this came from a senior bureaucrat, not an elected official. We've not heard definitively, the government back up that statement or deny that statement yet.
Okay, thank you very much indeed.
Yeah, of course, Andy, anytime.
Jeremy Sharon, that's some touchy stuff, obviously, Canadian or Indian Secret Service activities in Canada. Let's have a quick look at the TSX. It closed at a record high yesterday. It's under a little bit of pressure right now. Let's have a look at Atkins Realis, ATRL in Toronto. Maxime Sichev at National Bank has a buy on the stock, says Q4 results look strong, but parts of the outlook are mixed. And there was a surge, though, in nuclear revenue up 29%. So the market not wholesale, not overwhelmingly buying into the Atkins Realis numbers right now. We've lots more ahead. Welcome to the second hour of our show. Let's check out the big stories we're bringing you from our newsroom. The Canadian economy contracted to end the year. Data from StatsCan shows that gross domestic product shrank 0.6% in the fourth quarter, driven by a sharp decline in business inventories. The decline was partially offset by increased household spending, exports, and government outlays. Overall, GDP increased 1.7% in 2025, the slowest pace of annual growth since 2020. In a preliminary estimate, the agency suggests real GDP remained unchanged in January. China will begin halting tariffs on Canadian canola starting next week. The move comes after Prime Minister Mark Carney's visit to China in January, where a deal was discussed to drop tariffs on canola, peas, lobster, and crab in exchange for Canada cutting tariffs on Chinese electric vehicles. Fairfax Financial is the front runner to buy a majority stake in IDBI Bank, according to a report from Bloomberg. Fairfax is in advanced talks with the Indian government and is considered ahead of rival bidders. That 61% stake is valued at about $8 billion US. Fairfax was founded by Indian-born Canadian billionaire Prem Watsa, and this deal could mark the biggest foreign investment in India's banking sector. TSX under a little bit of pressure right now. No clear pattern in trading right now. I'm just seeing if the oil stocks not doing that much as far as I can see. Bunch of big banks down. Royal Bank is down about 250. Toronto down about $1.40. Shopify has dropped about $6, and it's a heavily weighted stock. Canadian Natural Resources holding its own right now. And let's have a look at the U.S. Do we have time to look at the U.S. markets? Oh, we can get back to those. We did see some selling there. Remember, chip stocks were weak yesterday after investors weren't thrilled by the NVIDIA results, and we saw some selling in NVIDIA. NVIDIA down again today. NVIDIA losing about 2.25% in early trading. One stock of interest here, Netflix has jumped about 9% because Paramount is seen as having beaten Netflix in that fight to buy Warner Brothers. Looks like investors are relieved that Netflix won't be entering into that massive deal. The topic of AI disruption could carry a leading startup all the way to a massive IPO. BNN Bloomberg contributor John Ehrlichman has more. John, you have a story about this on our website. Thanks for joining us.
Thanks, Andy. Yeah, and we're talking about Anduril, which is a company that's been around for less than a decade, but in a lot of the business circles recently, probably people have heard not only that they are getting ready potentially for an IPO, but this company is now estimated, based on some of the recent private round talks, to be worth about $60 billion US, $60 billion for a company that didn't exist a decade ago, and going back, call it a half dozen years, was valued at less than $2 billion. And, you just talked about what's happening with NVIDIA today. Regardless of how investors feel about where we are in the AI boom, the reality is that AI disruption is happening in lots of different industries, including defense, but happening in defense at a time of record spending. You talked about the Prime Minister's travels recently. Obviously, Canada is gearing up for a lot more defense spending. Many countries around the world are, but the question is, how do you spend that money wisely in 2026? And Anduril's advantage in the short term has been that they are embracing the AI era because they are basically AI first. I mean, they have autonomous drones that are a lot cheaper for countries to spend money on in the name of defense versus some of the massive programs from other companies out there. And so I think that the next few weeks, next couple of months will be very interesting because obviously it's been a little bit more jittery around tech recently, and yet here is a company that is growing quite quickly and is at the center of this new defense era we're all stepping into.
What about the impact here on the traditional defense companies?
So I think this is such an important thing to highlight, because you've got these, in the United States at the very least, homegrown players that get the lion's share of the business. Lockheed Martin, which some would argue is the biggest fish in the sea, and a company that works around the world with its F-35 program, including with Canada. They generated something like $75 billion in revenue last year, so it's not like they're going anywhere. And their largest customer is the U.S. government, which is quite common for a lot of these mega defense names. The question is speed. If they are built off of programs that were created, and that is true with the F-35 many years ago, does a company like Anduril have an advantage, especially if we see more of the kind of talk we've seen out of the White House recently? President Trump seems to have an issue, or members of his administration have an issue, when legacy defense companies take their money and do things like buy back stock. Shareholders obviously don't mind that, Andy, but I think there's been a big push to see these companies spend on the future of defense or risk losing business. And since companies like Anduril are already all in on that, I think the next round of contracts will be equally interesting to track.
John, thank you very much indeed. John Ehrlichman, you can find his story on our website, bnnbloomberg.ca. And John also is on the Ticker Take channel on YouTube. Just ahead, markets slipping as we end the month. We'll get perspective and some ideas for your portfolio. Markets under pressure on this last trading day of February. Of course, the S&P 500 is nearly at a record high, but there has been anxiety over the impact of artificial intelligence, including, of course, whether a big part of the traditional software industry will be hollowed out. Let's get perspective from Mark Sebastian, founder of Option Pit and Chief Investment Officer at Carmen Line Capital. Great to see you as ever, Mark. Thanks for joining us.
Good to be here.
So let's have a look at a one-year chart for the S&P 500. I mean, it's not that bad, is it? It's near a record high, but there are these concerns.
Yeah, I mean, there's a lot to unpack here because underneath the hood, the S&P 500 looks pretty good. And if you look at equal weight S&P, so the S&P 500 is cap weighted, which means the more valuable the company, the more it takes up the price behavior of the S&P 500.
Mm-hmm.
Equal weight looks at the individual sectors and equal weights those and then rebalances every quarter. In the middle of that sell-off on Thursday, equal weight was hitting a new all-time high. There is strength in energy, financials, industrials. All the old boring stuff has been performing marvelously since the beginning of December. At that exact point, that's when tech basically stopped performing.
That's interesting. So so it is limited in many ways to the techs, some of the Mag 7s, but in particular the software stocks.
Software and we've seen the mega caps, the Mag 7, which is really 9 names. It's the 7 plus Taiwan Semiconductor and Broadcom. Those names have stopped going up. Software has started selling off, but everything else has started to go up. And what we're experiencing, I believe, on the tech sector, when I say the word correction, people normally think like, oh, the market's selling off 10% or 20%, something like that. Corrections can happen in a different way. If you look at NVIDIA over the last 6 months, 6 months ago, it was almost exactly where it sits today. Meanwhile, those earnings have grown pretty dramatically. So what we're seeing is the largest company in the world was carrying a PE near 70, and now that price earnings ratio, with the stock kind of sitting here, has come back down into the 40s, probably heading to the 30s. So it's not that NVIDIA is going to maybe have a big sell-off. I just think until it grows into the earnings grow into its valuation, it's kind of dead money.
That's interesting. Yeah. So it's not that its prospects have diminished. It's just that people have got more information now about its profitability, or they hope they have. And so they're just refining their bets on the valuation.
Yeah. Well, when companies make the most gains in the stock market, it's when people are trying to figure out how much money they're going to make.
Right.
Not once the market has a pretty good feel on it. And I think we're kind of there with NVIDIA. We have a pretty good idea of how much money they're making, and that is now well priced into the stock, right? It's $4 trillion. So until we get kind of another hockey stick of growth in earnings, it's going to start behaving like a normal stock, not the kind of parabolic gains it made in 2024 as the market was starting to realize how much money this company was about to be making.
Tell us about some stocks, excuse me, that you've been buying. You have been adding some money in Microsoft.
Yeah, I think it's getting to the point here, below $400 where it's starting to look interesting. They're not going anywhere anytime soon. They're embedded into, every personal computer. They own pieces of Anthropic. They own pieces of OpenAI. Now, Copilot obviously could use some help, but if you look at the valuation of where Anthropic and ChatGPT could go, right there, you're looking at potentially trillions of dollars for them, and that's on top of their legacy businesses. I think it's gotten to the point here where it's starting to look like an interesting investment. I'm willing to put my toe in the water here.
I'm not sure if we can show this chart. The company hasn't been public very long, but Reddit. Of course, it's the noisy marketplace for ideas, always entertaining. Shares have come off their highs, but you see potential here.
Yeah, this is a volatile one, but they have a blueprint laid out for them in what Meta did with Facebook and Instagram. And if they can implement that, this is going to be a $100 billion, $200 billion company. This is not one for the weak-stomached because it is highly volatile. But, if I'm in my 20s, 30s, and, now I'm in my 40s, but my investment horizon is, to really need to take money out of my retirement is still, 15 years away, that's one that I'm willing to put some dollars behind.
So the market cap now only about 28 billion. And it is interesting, Reddit. Of course, it's cluttered. There's so many discussion lines, but there's some pretty smart people on there, I found.
I mean, you look what they did, what Reddit itself did to GameStop, and you can see the power of what that community is. And they are going to sell so much data to companies like Anthropic and OpenAI and XAI, you name it, because that is real people interacting with other real people. That's kind of the best data scraping you can get for working on AI engines.
IBM has suffered lately, but you see value there?
Yeah, I mean, I think they literally the hilarious thing would be if IBM was put out by what they basically created, right? And they dropped the ball really bad, but they're implementing AI in real world scenarios and directly with companies, and they're selling. So yes, do they have risk on the software side? Yes, but is IBM going anywhere? No. They took $100 out of the stock in a month. This is the level I'm willing to start to play.
Yeah, way back in 1997, their program beat Garry Kasparov in chess. So they've been a player in this market for a long time. One stock that you're not keen on right now is Apple. Why is that?
Well, I think it's just not an interesting company anymore. They're not developing new product. They're not innovating. They're literally just relying on people continuing to upgrade this thing. They didn't invest in AI. Now, if AI ends up being completely commoditized, that's going to end up being a win. I'm not so sure that's going to happen. Apple's not going anywhere. But start thinking about it more like you would have thought about legacy AT&T or utility. It's going to pay you a dividend. It'll grow with inflation, but the excitement in Apple is just not there. I think it's a really good stock for somebody in there that is getting near retirement because it's a safe haven. One way we know that the behavior of Apple has changed is it tends to be a really strong performer when the rest of the market is selling off because it is people are using it as a store of wealth. They jump into that one to kind of shield themselves from major market sell-offs.
Yeah, I've heard that people, when they're nervous, they park money in Apple. Yeah, that's interesting. Yeah. We better go, but that's a bit ignominious for them. Yeah. Mark Sebastian has been our guest, founder of Option Pit and Chief Investment Officer at Carmen Line Capital. We have lots more ahead. We're going to sit down with the CEO of Energy Fuels, a U.S. player in uranium and vanadium. We'll be right back with Mark Chalmers. Let's take a very quick look at the markets, and you can see the TSX is down slightly, the S&P likewise, and the NASDAQ. So we're ending February on a somewhat sour note, let me just give you a year-to-date scorecard. The S&P now up only 0.1% this year. That's the S&P, but remember Mark Sebastian pointed out that a lot of stocks are actually doing better under the surface, because the big index has been dragged down by weakness in some of the Mag 7 names. Toronto's doing much better. It is up around 8% so far this year. And the NASDAQ is down about 2.5%. So we have seen money coming out of these big tech stocks. I'm just looking at the Mag 7 itself to see how it's been doing this year. That prominent group down about 6% so far. And wow, this is interesting. None of the Mag 7 stocks, according to my screen, on a total return basis, are up this year. Apple has held up a little bit better. It's down about 0.5%. But Microsoft has slid about 18% this year. Amazon's down about 10%. Same for Tesla. Smaller losses for Alphabet, Meta, and NVIDIA. One stock that we have seen some selling in, I mentioned it earlier, Atkins Realis, ATRL. That stock giving up all of its year-to-date losses, down, as you can see. Well, it was down more earlier. It was down as much as 9.5% earlier. and it did hit its lowest level since December. The fourth quarter underlying profit missed expectations, and also the cash forecast for the year fell short of analyst estimates. And now apparently the EBITDA was hurt because a heavier loss on a lump sum turnkey project. And the company sees net cash from operating activities of about $500 million this year, 500 million, but the estimate was for just north of 570 million. Nuclear revenue huge for this company. Total revenue in the fourth quarter, almost 3 billion, but nuclear revenue was about 600 million of that. The U.S. Supreme Court decision blocking some of U.S. President Donald Trump's tariffs has thrown U.S. trade policy into turmoil. He is scrambling for a new path. Bloomberg Originals looks at what his trade war has accomplished so far.
For President Donald Trump, few things appear to matter more than
tariffs. Tariffs. Reciprocal tariffs.
A lot of tariffs.
The most beautiful word in the dictionary is tariff.
Now his signature policy has hit a roadblock.
Trump's biggest legal defeat since returning to the White House.
The Supreme Court striking down President Trump's tariffs.
It's a major blow to President Trump's economic agenda.
2/3 of the tariffs that President Trump implemented in 2025 have essentially been ruled illegal.
That really has taken away one of the main ways in which President Trump has disrupted the global economy.
But Trump says he isn't backing down.
Today I will sign an order to impose a 10% global tariff under Section 122.
A day later, he upped the ante, saying he'll raise that rate to 15%. But these can only stay in place for a maximum of 150 days.
What he is going to have to do now, instead, is use tariff authorities that are much narrower and in which he really has to prove an economic case for the need for them.
For US trading partners around the world, it's causing tariff whiplash all over again.
The EU was the quickest to react so far. They have moved to freeze the implementation of their side of the trade deal that was signed with the US. There are a few countries that actually stand to lose despite facing lower tariffs now than before the ruling. So countries like Vietnam, what they've lost is the comparative advantage that they had relative to China. China is probably the biggest winner from this ruling.
Almost all countries and corporations want to keep the deal that they already made.
So, how will this affect businesses and consumers, or the trajectory of Trump's remaining 3 years? And what happens when the 150 days are over?
We have maximum uncertainty over where trade policy goes from here.
This wasn't a battle before the Supreme Court between President Trump and China or a faceless corporation. The main plaintiffs who challenged these tariffs were a toy company, Learning Resources, and a whole coalition of other small businesses who really felt like President Trump and his tariffs were an existential threat to their businesses.
At the centre of the fight was a law called the International Emergency Economic Powers Act, IEPA. It allows a president to regulate some aspects of commerce after declaring a national emergency.
Trump claimed that it gave him the power to immediately put a tariff of any level on goods from anywhere, and the Supreme Court ruled that just wasn't the case.
What the court didn't make clear is what happens to the money already collected.
Essentially, the Supreme Court ruled that the U.S. collected $170 billion in tariffs unconstitutionally.
Trump himself has indicated that this is going to take years of litigation to calculate and distribute refunds.
There is the possibility that it could just be a very clean process. The Customs and Border Protection knows who paid the tariffs and knows how to refund them.
There have been episodes where tariffs have been refunded in the past. That's not unprecedented, that's not unheard of. But the scale of this, I think, is unprecedented.
Think of it as the mother of all tax refunds.
Trump had promised that foreign countries would be the ones paying for his tariffs. But
As it turns out, the foreign exporters aren't eating the tariffs. They're 90-95% passed through to U.S. importers and their customers.
Reducing the US trade deficit was one of Trump's stated goals with tariffs, but in truth, they've barely moved the needle.
The United States last year in 2025 had a trade deficit in goods of around $1.2 trillion. It was almost exactly the same size as the trade deficit that it had in 2024.
The main impact we saw from the tariffs was to reshuffle trade away from China and towards Mexico and other Asian countries, more than reducing the aggregate trade deficit.
And so far, Trump's trade policies have failed to deliver on another long-held promise: rekindling US manufacturing.
Trade policies will return significant manufacturing jobs to our country.
The problem so far for President Trump is that 10 years on, the situation in manufacturing doesn't look that much better. In fact, in the last year, the U.S. lost more than 80,000 manufacturing jobs. That's even as these tariffs went into place. A lot of manufacturers rely on imported components, and if those imported components and big things that they use like steel and aluminum are more expensive as a result of tariffs, they can't hire more people. They can't grow. The costs are just higher.
More tellingly, if we separate that industrial production into industries that faced higher than average tariffs and lower than average tariffs, we see that any growth that was there was really driven by the lower tariffed industries, things like pharmaceuticals, electronics. Whereas the higher tariffed industries, think autos and metal sectors, faced much slower production growth.
Manufacturing is no longer going to be a big source of employment. The jobs that have gone, most of those jobs are not coming back. The principal driver of that trend is not trade, it's technology.
But it's Trump's foreign policy, not domestic, that now may need to change the most.
The biggest blow to Trump from this Supreme Court decision is really how it hits his ability to shape geopolitics in the world. He's used tariffs to threaten India and its purchase of Russian oil.
They will not be buying oil from Russia.
He's used the threat of tariffs to also interfere in domestic politics, like in Brazil. Those are all things he was able to do because of this authority he claimed that gave him this kind of immediate ability to increase his leverage, to apply pressure on other countries.
But that may have backfired.
I don't think there's anything wrong by any means with an American president seeking American advantage. That's the job. The question is, are these methods working? So if you think of Europe, if you think of Canada in particular, governments are weak in many ways in relation to the US. The demands that the US is making are so off the charts in terms of their previous experience. I think they're struggling to process it. You know, can we rely on the US commitment in NATO? And the controversy that followed the president's demands about Greenland.
We want a piece of ice for world protection.
There were Europeans who were actually wondering whether at some point European soldiers would be fighting US soldiers. Extraordinary.
All of this is happening in the run-up to the US midterm elections.
Poll after poll shows that these tariffs are incredibly unpopular and that people associate them with this broader issue of affordability. It's just another way that they see the government making life harder, raising prices.
Republicans should be asking themselves if they want to keep backing this policy, which is just meeting obstacle after obstacle when it comes to implementation.
Trump wants Republicans to win the midterm elections. It's going to be harder for them to do so if a lot of voters don't like his signature economic policy.
Okay, we are going to stick with trade after the break. Citi has a big report out on the importance of the Canada-US-Mexico trade agreement. We're going to get a scorecard on that deal after the break. Citi is out with a major report on the Canada-US-Mexico trade agreement as we move potentially into a renegotiation of that deal this year. We're joined now by one of the authors of that report, Sarah English, Managing Director of Global Governmental Affairs at Citi. Sarah, thanks very much indeed for joining us.
Thanks very much for having me.
Give us the one or two big takeaways from this report. What is the important thing you want people to realize when they're reading this piece of work?
I think, our report, what we just published a couple of weeks ago, I think really highlights the benefits of the agreement as a trilateral agreement. And I'll just highlight two key numbers for you. Mm-hmm. The first one is the growth in trilateral trade since the agreement's inception has grown to $1.9 trillion. That's a $400 billion increase in just, according to our numbers, in 4 years. That's a really big number. The second thing is the boost that it's gone to jobs and creating regional supply chains. And according to our facts, Canada is now the third largest investor in the United States for foreign direct investment and the largest job creator in the last 4 years. So the agreement really has strengthened regional trade and brought lots of benefits across the borders.
Can you did you manage to quantify, and I know it's very complicated, did any particular country do best out of the deal over that period?
I mean, I think when we looked at the report according to our data, it shows a lot of benefit to the United States with having the regional strength of the trade agreement. But also, if you think about it, it's an update to the NAFTA agreement. So we're talking about 30 years of partnership. Mm-hmm. And companies across the borders have built these supply chains. And the updated version, which is the USMCA, has only strengthened that supply chain. So the benefits are actually spread across all three nations.
Can you talk at all about, say, Mr. Trump's setback at the Supreme Court? Is that likely to affect the renegotiation of the deal? I know that's not really part of this piece of work.
It's not. And if you look back to the beginning last year in Liberation Day, USMCA goods and imports had been excluded from those tariffs. So I think, and they continue to be when they issued the new executive order using a different authority, USMCA continues to be excluded. So I think that says a lot in terms of the strength of the agreement and the importance of the agreement.
I mean, I know it's a fraught question, but do you think major change, if and when it's renegotiated between the three countries, if we do get a trilateral deal, are there any major changes you think will be made?
I think, in our report, we point out that there's likely to be a bumpy renewal, and I think that's probably the right category to put it in. I think there are certain things that need to be updated, perhaps around economic security. These are things that have been in the press. And these are to really strengthen supply chains that have been established already. And I think there might be some other updates, perhaps on the digital front, maybe even critical minerals. That's a huge opportunity now for all three countries.
You gave us the main findings. Do you think there's anything about the trade agreement that people don't realize or that politicians maybe should acknowledge more or that the public have missed out?
It's a great question. I think, if you go to, individual states or individual provinces, you'll see just how integrated the trade is. Mm-hmm. When we talk to our clients, not just in Canada, Mexico, and the US, but we're talking to global clients that are looking at North America and our regional supply chains here as an opportunity for them to invest. So I think that's something that perhaps is not as easily done in the data, but if you talk to companies, if you talk to small businesses, you can hear that benefit.
That's interesting if you get out there on the ground, because of course, I mean, the US economy is so vast that any overall number is going to be a bit misleading. And it's funny, really, USA is in a way a continent, isn't it? In a way, the Great Lakes economy is very closely integrated with Ontario, for example.
Absolutely. And if you look across the Canadian border, and if you look across the Mexican border in the United States, those economies are so closely tied. And all the production has moved to those border states to help facilitate that trade even more efficiently.
Thank you very much indeed. I really appreciate it, Sarah.
Thank you.
Sarah English, Managing Director of Global Governmental Affairs at Citi. Up next, we're talking uranium with the CEO of Energy Fuels. That's ahead. Energy Fuels is a very unusual beast. It produces uranium in the United States. In fact, the company says it is the biggest U.S. uranium supplier or producer. It's also active in other critical minerals. Let's get more from Mark Chalmers, President and CEO of Energy Fuels. Great to see you, Mark, as ever. Let's start off with uranium. You produced quite a bit, just over 1 million pounds last year. And remind us, where are you producing the uranium?
Yeah, Andrew, most of our uranium production is coming out of the Four Corners region of the United States and its conventional mines. And we really started ramping up our uranium production in 2025, and we're continuing to ramp that up materially in 2026. So we are the largest producer of uranium and lowest cost producer of uranium in the United States, and we're very proud to continue to lead the pack on that front, as well as having the rare earths behind our uranium production, but catching up very quickly globally.
And of course, the Four Corners, beautiful part of the world. It's where Arizona, Colorado, New Mexico, and Utah meet at a single point. I was there many years ago. And you're engaged in conventional uranium mining right now. You could potentially go to this solution recovery like they do in Kazakhstan.
Yeah, look, we have a solution ISR mine in Wyoming that's on standby, but right now we have 3 uranium mines in Arizona and Utah that are in production, but we also have 2 additional conventional mines that we're planning to bring online and rehabilitate in 26 and production in 27.
And where are you selling your uranium? Who do you sell it to?
Nuclear utilities. We have 6 contracts with U.S. utilities, and we've been filling contracts over the last couple of years, and those contracts are starting to ramp up because between now and 2030, 2031, that's when most our contract deliveries are due. 2030, 31, that's when they'll peak? Yeah, I think we have one contract that goes in 2032, but no, it ramps up. And we have about 50% of our production under contract, and the remainder gives us some opportunities to either hold that material or potentially sell a limited amount on the spot market. And tell us what you're doing in rare earths. Are you getting rare earths out of the same deposits? Well, what we have had a focus on monazite sands, and we've acquired properties all over the world to bring that monazite material to the White Mesa Mill for processing. Okay. We actually have a recovery circuit, what we call phase 1, that can currently produce about 1,000 tons of NdPr per year, but we have plans to expand that up to 6,000 tons of NdPr, which is the size of Linus in Australia, and would be absolutely world significant. So the feeds for the rare earths, right now, some of the feed is coming from Florida and Georgia, but over time that will increase in places like Australia, Madagascar, and Brazil. Now, America has, or the White House did launch something this month called Project Vault, a $12 million venture to create a strategic critical minerals reserve. And you're involved in that? Oh, dear. I think we lost our guest. There is a look at the stock, though, 1 year. And this stock has come up dramatically since 2025. Got to go to break. Sorry that we lost Mark Chalmers, CEO of Energy Fuels. We'll be right back, though.
Time for hot picks. Today we are looking at three plays in materials and chemicals. Our guest has Corteva as a top pick. He says this agricultural supplies company is undervalued and sees long-term potential as it plans to separate its crop and seed business. We're joined by Seth Goldstein, Senior Equity Analyst at Morningstar. Seth, thanks very much for joining us. Just tell us, what does Corteva do and what are their plans?
Yeah, so Corteva is one of the leading patented seed and crop protection chemical companies in the world. And so these are the essential products that farmers need to grow crops and protect crops from insects, weeds, and fungus pests. And so Corteva's leading portfolio of intellectual property really creates value for farmers because it allows farmers to grow higher yields with their crops. And many farmers turn to Corteva for their seeds and chemicals. Even when crop prices are low, they still pay up for Corteva's products.
And why are they spinning off the seeds business?
Well, they see two divergent growth paths for the seeds and the crop protection business, and they want to allow each to be fully funded and grow independently of one another versus having to, say, in the crop protection business, develop products exclusively for the seeds business. Now the crop protection business can focus on developing the products it thinks will be the best of value for farmers. And so they see a good spinoff right now. Corteva has a very strong balance sheet, net cash position, and really this is going to be two leading companies instead of one, both a seeds leader and a crop protection leader post spinoff.
The stock has been doing well. Is it a cyclical name in the sense that it rises and falls with crop prices?
Not as much. For agriculture, it's very cyclical based on crop prices, but for Corteva, they're a little less cyclical versus other ag companies because the seeds business tends to do well based on Corteva's new seed development and how they do versus rivals such as Bayer versus just rising or falling with general crop prices.
Mosaic, a giant fertilizer company, huge phosphate franchise. They're in the other crop nutrients, though, as well. Why do you like the look of this one?
Well, Mosaic has had some company-specific issues at both its potash and phosphate mines over the past year, and this has really led to higher unit production costs. We have seen phosphate prices fall slightly for the start of the year, but we expect prices will stabilize in the low $600 per metric ton range. We think potash prices will remain in the mid $350 per metric ton range. And longer term, as Mosaic produces more potash from its low-cost Esterhazy mine, and as Mosaic is restoring its phosphate production, we expect unit production costs will fall and profits will grow, generating positive free cash flow for Mosaic, whereas the current results don't reflect where we think they can get to under mid-cycle conditions.
Sorry, just remind us, what problems have they had over the past couple of years?
Yeah, they've really had some long-term mine issues, both their phosphate mines in Florida and their Canadian potash mines, and they've really had some challenging production issues. They've been trying to ramp up these productions. In Florida, they've also had some storm damage impact some of their mines in recent years, and so really they've had to spend a lot of extra costs over the past year and into this year to really make sure that the long-term health of these mines is set up so that they can ramp up production. And in the meantime, this has created some higher near-term costs. And I think the market's extrapolating this to assume it goes on longer than we think it will.
Eastman Chemical, now they were affected by the U.S. Supreme Court decision against some of President Trump's tariffs. Tell us how that played out.
Yeah, so President Trump, after the U.S. Supreme Court came out and said the tariffs were illegal and unconstitutional, President Trump said the tariffs will go ahead. And this really hurt Eastman and all chemical stocks because for Eastman, they sell a lot of specialty chemicals to companies that make consumer products that are then exported to the U.S. And so there's really big secondary demand impact and secondary impact of the tariffs from Eastman due to lower demand from their customers. And really what we've seen is this has caused chemicals, which is already seeing bottom of the cycle type of demand. The bottom of the cycle conditions just continue and will continue into 2026. But The good news for Eastman is they have a good balance sheet. They generated free cash flow last year exceeding dividends, so we don't see the dividend as at risk like some of their chemicals peers that have had to cut their dividend. And Eastman is well positioned for a recovery. So when we see the eventual demand recovery, we think Eastman will see profits snap back in quickly short order because their specialty materials are essential to their customers and just tend to work better than their customers, which gives them very strong pricing power.
And what about the dividend? Is that one reason why investors buy this stock?
It is. Right now, you get a really high dividend yield, and you don't have to worry about it being in jeopardy versus, Dow, Lyondell, Celanese have all had to cut their dividends over the past year due to not generating enough positive free cash flow or high debt levels. Eastman has a better balance sheet. Eastman generated free cash flow above dividends. And so we see the dividend as very safe, and essentially investors can collect the dividend and wait for the chemical cycle to recover.
That's interesting, and a big yield, about 4.5% on Eastman Chemical. Seth, thank you very much indeed for joining us.
Thanks for having me.
Seth Goldstein, Senior Equity Analyst at Morningstar. As we get ready to hand things over to the one and only Roger Peterson, one of Canada's national jewels, with Morning Markets, let's check out some of the big stock movers of the past week. And a hot performer has been, there's the TSX over the past year. Maybe we can have a quick look. Actually, I'm curious now, how has February played out? Year to date, remember I told you the TSX is up about 8%, and you can see it's up 35% in the past year. Month to date, though, the TSX, not too bad for the TSX, up about 7.5%. The NASDAQ, though, has sagged about 3% this month, and the S&P 500 is down about 1%. One mover over the past week to the upside has been Torex Gold. Look at that, 20%. Gold stocks have been things of beauty over the past, it must be 2 years now. And gold was moving up higher once again. So Torex Gold, this is actually February 19th, we got numbers from them. They come in with profit, adjusted profit, 176 a share, beating the 114 estimate. And let's have a quick look at one stock that came under pressure, Go Easy. That one's sagging about 9% this week. Now, I don't recall seeing any news, but I miss a lot. I need to get out an awful lot more. We are awaiting fourth quarter numbers from Go Easy. That's going to be March 25th after the market closes. One worry with Go Easy has been possible loan losses because they lend to riskier customers. People, of course, are worried that there could be rising defaults. TD Cowen actually downgraded the stock in January, saying that consensus was too high, that the forecast for consumer loan yields were too optimistic. Roger Peterson is coming up next with Morning Markets. Sit tight.